Gold reclosed above $5,000, and it did it in a way that should make any serious market watcher sit up straight. 40 after a week where the market had just printed a record reference high near 5,626 and then snapped lower hard enough to convince plenty of people the move was over. Not months, not weeks. In 48 hours, the story flipped from new era to failed breakout and back again. They said gold could never trade with that kind of speed at that kind of altitude without something breaking. And something did break, just not the thing most people are looking at. And here's the uncomfortable part. When you see a move like this, most people instinctively blame the headline catalyst of the day. A speech, a data print, a geopolitical flare-up, something clean enough to fit in a single sentence. But that isn't where the real leverage lives. The real leverage lives in the plumbing, collateral, clearing, and the invisible rules that decide how much exposure the system can carry. Institutions see those rules first because their risk systems are wired directly into the margin calls, the funding desks, and the clearing statements. It was forced flow. It was balance sheets getting sorted in real time. It was the market being told, mechanically, who is allowed to stay in the trade at these levels and who isn't. Once you understand that, the move above 5,000 stops looking like a miracle and starts looking like a filter. Welcome to Signal and Substance, where we decode what matters before it becomes tomorrow's recycled narrative. If you appreciate calm, evidence-driven breakdowns that connect filings, flows, and structure to price action, stick around the way you'd listen to the one elder who never shouts but never misses the point, and drop a comment with where you're watching from, because gold is global, and the way this story spreads depends on where you're standing. Here's what happened, with the kind of detail that keeps you from being fooled by a clean headline. After the surge into the 5,626 area, gold didn't simply cool off, it whipped. The selling wasn't a gentle drift. It was sharp enough to feel like someone pulled the floor out from under leveraged positions. 40. That reclaim mattered, not because it was pretty, but because it happened with heavy participation. Estimated volume around 140,462 contracts. And open interest near 400,187, actually ticking higher by the end of the session. That combination is a tell. Big volume with stable or rising open interest is not the signature of a crowd simply abandoning a trade. It's the signature of a transfer. Positions are changing hands. Someone is getting out, and someone else is taking the other side and staying. If you only watch price, you miss that. If you watch participation, you see that the market is not dying. It's being reorganized. Now layer in the backdrop that made the move even more explosive. 8%. In normal markets, a softer dollar can support gold, and that relationship is familiar enough that people stop thinking about it. But what was abnormal here wasn't the direction, it was the intensity and the timing. A normal dollar-gold relationship doesn't usually produce a record high near 5,626, and then a violent reversal, and then a recovery above 5,000 in the space of a couple of trading days. To understand why, you have to understand margin, because margin is the quiet dial that controls how far and how fast futures can move. Margin isn't a fee, and it isn't a punishment, it's collateral. It's the cash or eligible assets you must post to hold a position. When margin requirements rise, the effective leverage in the system falls. When leverage falls, suddenly someone has to come up with collateral. And when collateral is demanded, people sell what they can, not always what they want. On January 13th, 2026, the margin framework for precious metals shifted in a way that sounds technical but behaves like a regime change. The exchange system moved toward a percentage of notional methodology for margins, gold, silver, platinum, and palladium. Translate that into plain English and it becomes painfully simple. When the price rises, the required collateral rises automatically because the notional value of the contract is larger. In a rising market, your collateral demand climbs with the price. Then, as volatility intensified, margin increases were layered on top anyway, with increases cited around January 30th, February 2, and again effective after February 6. That timing matters. Exchanges raise margins when volatility spikes because they want to protect the clearinghouse and reduce the chance of default. It's risk control. But risk control has side effects. When a market is already stretched, margin increases force a liquidation cascade from the most fragile participants first. The market doesn't ask whether they're right or wrong. It asks whether they can pay. This is why the move above 5,000 can't be understood as a simple vote about fear, inflation, or currency. It's also a vote about balance sheet strength. Some players couldn't. They sold. Others could. They bought. The shakeout created pain, but it also created clarity. Now, if this feels familiar, it should, because this rhythm has appeared in gold across decades. In 1980, gold surged into a blow-off phase driven by inflation fear and confidence stress, and it didn't top out because the story suddenly improved. It topped out because volatility exploded. Leverage hit its limit, and the market couldn't carry the same speculative weight at the new price. The result was a brutal reordering, followed by years when gold looked boring to casual observers, even as it quietly rebuilt its role as a monetary alternative. In 2011, the same pattern showed up in modern clothing. After the global financial crisis, sovereign stress and policy accommodation pushed gold toward a then unthinkable peak near 121. The playbook was familiar: accelerating momentum, rising participation, then tightening conditions as volatility rose and the market became too crowded on one side. After the peak, the market spent time digesting, not because the world suddenly became stable, but because the market had to clear excess leverage and reposition real holders. In 2020, gold pushed through 2,000 in an environment of shock and extraordinary policy response. Again, once the breakout became consensus, the constraint reappeared: how much leveraged exposure can be carried when uncertainty is high and volatility is unstable? You got sharp moves, rapid corrections, and a long period where the market punished anyone who expected a straight line. Now, in 2026, the same playbook is running again, but with a twist that changes the character of the moves. The margin mechanism itself is more sensitive to price because it's tied more directly to notional value. That means the stress of a rally grows with each step higher. Every surge becomes self-tightening. The market can still rise, but the path becomes more violent because the collateral burden climbs faster and the weakest leverage gets squeezed out sooner. That brings us to the institutions, because this story is not about nameless forces. It's about visible entities that sit at the junctions of liquidity and settlement. The exchange and clearinghouse set the collateral rules. Futures commission merchants enforce them on clients. Large banks intermediate between paper claims and physical sourcing. Central banks and official institutions buy and hold physical metal for reserves. ETFs and pooled products translate public demand into market flows. And macro funds, with their models and risk limits, act like accelerants when conditions align. Start with the exchange and clearing system, because that's where margins actually become reality. When a percentage of notional framework is used, the collateral requirement adjusts with price, which stabilizes leverage from the clearinghouse perspective. That's the point. But for traders, it means something else. A rising market becomes more expensive to hold, even if volatility stays the same, and when volatility spikes, it becomes more expensive again. So a rally is no longer just a question of being right about direction. It's a question of being funded enough to survive the path. Now add the timing of repeated margin increases into early February. That's a constraint. Constraints create flows. They force some participants to reduce. They force others to change tactics. They force the market to migrate from one type of holder to another. This is where the story of flows gets real. Flows aren't just people choosing to buy or sell. Flows are also the movement of risk across instruments. When margins rise, some leveraged longs reduce, some leveraged shorts reduce, some shift from outright futures to options. Some move exposure into spreads that require less margin than outright directional positions. Some shift from exchange-traded exposure to over-the-counter structures. And some exit entirely because their return on capital no longer makes sense at the new collateral requirement. None of that is ideology. It's arithmetic. And the participants who remain are the ones who can carry exposure through volatility and collateral adjustments. Those may be institutions with deep liquidity. They may be commercial hedgers who can offset futures exposure with physical inventory. They may be macro funds that treat margin as a manageable cost of doing business. And they may be long horizon holders, including official sector buyers, who don't care about short-term mark-to-market swings the way a levered trader does. When the market transitions from a mixed crowd to a concentrated crowd, price behavior changes. It can become more stable at key levels after a shakeout because the marginal forced seller has been removed, but it can also become more jumpy intraday because liquidity can thin when fewer participants can afford to play. Both outcomes can happen in the same week. 40 settlement above 5,000 looks like thinning liquidity plus stronger hands. Now, there's another narrative running alongside this, and the tension between them creates the dislocation that explains why so many people feel confused. The official sector demand story has been prominent, including reports of ongoing central bank accumulation. One example widely cited in current coverage is China adding 40,000 troy ounces in January, described as the 15th consecutive monthly increase. Whether that exact figure is large or small in the context of global flows is less important than what it represents: a buyer category that is not primarily motivated by short-term price swings. That kind of buyer changes the floor of a market. It doesn't necessarily explain the intraday violence, but it changes what happens after the violence because it creates a persistent bid that doesn't vanish just because margins rise. Official accumulation doesn't need leverage. It needs policy and reserves. That means it doesn't get forced out by collateral calls. So while leveraged participants are being shaken out, steady buyers can keep accumulating, and that creates the kind of rebound you saw back above 5,000. So where is the dislocation? It's in the way two sets of signals can appear to contradict each other. Gold holding above 5,000 after a violent shakeout is not what you see in a market where confidence is high and liquidity is abundant. On the other side, the exchange and clearing system is tightening collateral as if the biggest risk is the speed of the move itself. That's not a moral judgment, it's a structural response. If price is moving fast, defaults become more likely, so collateral must rise. When a market is simultaneously being bought for safety and forced to deliver for stability, you get strange behavior. You get rallies that feel unstoppable until they hit a collateral wall. You get sell-offs that feel like the end until they exhaust the forced sellers. And you get recoveries that look irrational to anyone who assumes markets are only opinion. Markets are also constrained. This is where paper and physical dynamics become relevant without drifting into sensationalism. Futures contracts can scale quickly because they are standardized and liquid. Physical gold cannot scale the same way because metal must be sourced, transported, insured, and settled. That creates friction. When paper demand accelerates, price can move ahead of physical supply chains in the short run. That friction expresses itself in spreads, in delivery demand, in inventory management, and in the premium differentials that appear when logistics can't instantly match financial appetite. So when margins rise and leverage is squeezed, paper demand can contract quickly, while physical demand can remain steady. That divergence is the dislocation. Paper can be forced to sell. Physical is often held. Paper can flip in hours. Physical flips in months. When those timelines collide, volatility spikes. Now let's go back to the hard numbers because this is where opinion stops and structure begins. On February 9th, the market did not reclaim 5,000 on thin air. Estimated volume, around 140,462 contracts is large participation. Open interest around 487, with a small increase on the day, indicates positions were not simply being closed out across the board. If the move had been a pure panic exit, you would expect open interest to collapse. Instead, it held. That means someone replaced someone. That is transfer. Transfer behavior tells you the market is not finished. It tells you the market is moving from one set of hands to another. And in a margin-driven environment, the hands that get replaced are often the ones with the most fragile funding. That doesn't mean every seller was weak and every buyer was strong. It means the marginal forced flow was likely one-directional. People sold because the collateral rules demanded it, not because their long-term view changed. Now, here's where it gets interesting. A margin system tied more directly to notional value changes the psychology of breakouts. In the old world, traders could ride a rally and worry about margin only when the exchange announced a hike. In the new world, the collateral demand grows as the rally grows. That means participants feel the cost of the move in real time. If gold jumps, the system quietly asks for more collateral. If volatility rises, it asks for more again. That creates a persistent friction that can turn what looks like a clean trend into a sequence of surges and shakeouts. But friction doesn't stop a trend. It changes who can carry it. Think of it like this. Imagine a highway where the toll automatically rises the faster traffic moves. At low speeds, almost anyone can drive. At high speeds, only those with enough cash keep going. The speed limit isn't posted, it's enforced by your bank balance. That is a crude analogy, but it captures the essence. The move itself increases the cost of participating in it. When gold ran up toward 5,626, it wasn't only pricing a macro story, it was also testing the capacity of leveraged positioning to survive the new collateral math. The sharp reversal was what happens when the toll spikes and a portion of traffic slams on the brakes at once. The recovery above 5,000 was what happens when the road clears and the remaining drivers are better funded. Now, the question becomes forward-looking without turning into prediction. What does this structure usually lead to, historically, when a market reclaims a psychological level after a margin-driven shakeout? You typically see one of three paths. So the first path is consolidation with elevated volatility. The market holds a broad range, revisiting 5,000 repeatedly, building a new base, while participants adjust to the new collateral reality. In this environment, headlines will oscillate between bubble and collapse, because the range is wide enough to generate drama, but the underlying process is simply repricing and reallocation. People who only understand direction will feel whiplash. People who understand structure will recognize a market building its next platform. The second path is a renewed push higher, but led by different hands. If the weakest leverage has been flushed out and the market still has a persistent bid from longer horizon demand, the next advance can occur with fewer sellers left to be forced out. Paradoxically, that can make the next move cleaner, even if it is still volatile, because the market is less crowded with fragile positions. In that world, new highs are possible, but the moves will likely come in surges and pauses, not in a gentle climb. The third path is a deeper liquidation that looks like a crash, but functions like a reset. If volatility spikes again and margins rise into it, collateral calls can trigger forced selling that overshoots to the downside. That's when narratives become emotional because price drops feel like judgment. But structurally, those moments are often about cash, not conviction. Someone needed collateral, and the fastest way to get it is to reduce exposure. Those events can be violent, and then, just as quickly, they can create the conditions for stabilization when the forced flow exhausts. So how do you tell which path is taking shape? You watch the indicators that reflect participation quality and financing stress. Watch what happens to open interest after sharp down days. If open interest collapses, that suggests widespread position closure, which can signal deeper deleveraging. If open interest stays resilient while price stabilizes, that suggests transfer to stronger hands, a sign the market is absorbing stress rather than breaking. Watch volume at key levels. Heavy volume on a stabilization day is different from heavy volume on a breakdown day. Stabilization volume suggests two-sided business, not just panic. Watch the dollar, but don't worship it. 874, being down on the day is a clue, not a conclusion. If the dollar weakens and gold rises calmly, that's macro. If the dollar weakens and gold swings violently, that suggests the macro relationship is being amplified by structural leverage. And watch margin and volatility notices, because in a market where collateral is the gatekeeper's decisions become part of the trend.